and welcome to this week's educational webinar. My colleagues, I'm Mahesh, and I would like to thank you for joining. Hope you are all keeping safe. Our topic today is about the classical technical analysis, which relies on the price action itself. So first, we will start by giving a small definition to technical analysis. We talked about it on Wednesday, but it's a small reminder. So technical analysis is an analysis methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. So the trader will rely heavily on only the price itself, the price action itself, and volume. So a core principle for technical analysis is that markets reflect all relevant information impacting the market. So a trader will only think, a market analyst or a technical analyst will only look for the history of a security or commodity trading pattern rather than external drivers such as economic, fundamental, and news events. So we believe that from a technical analysis perspective, we believe that the price discounts everything. So everything that's happening around is all discounted in price, and so it all affects the supply, the factors or the motion for supply and demand. Therefore, it affects the price. So the price, a core principle for technical analysis is that the price discounts everything. The advantages of technical analysis are that it can be applied to any trading instrument and in any time frame. So whatever instrument you are trading, whether you are trading stocks, you are trading commodities, currencies, you can apply technical analysis, and you can also do your forecast for a shorter and longer period. So it doesn't matter what time frame you are studying. You can base your forecasts based on, you can choose your time frame, your relative time frame, based on your vision or your needed assumption. So for example, if you want to study, you want to take a trade for a longer term, you have to study more history of an instrument. You have to go back in data for like weeks and months and years. Even if you want to plan a trade for a couple of hours, also you can check the relative performance within the past 2 days in order to enter a trade or to look for a trading opportunity. So this is in brief technical analysis. So the core principle is that it discounts everything. Its advantage is that it can be applied on different instruments and in any time frame, and you can apply it for short-term perspective and longer time frame. So today we're going to talk about the classical technical analysis. The classical technical analysis is the basics, is among the basics of the technical analysis, and it only uses price action itself. So we study the price action. So whatever movement we witness in a price, we use it in order to forecast the future price of a certain instrument. So we'll start with trend lines and channels. They're very simple. I'll also explain how you can apply trend lines and channels, and how you can draw them also on the in your trading platform. So what is a trend line? Trend line basically is a bounding line for the price movement of a security. So if a security is moving higher, we believe that it will be bounded by a certain trend line. Market moves in a trend, so we have to assume that market is moving in a certain trend. This trend consists of waves. These waves, they have peaks and they have troughs. So the market moves in waves. These waves, they have peaks and troughs, and based on the direction of those peaks and troughs, this forms the direction of a certain trend. So if we have higher highs and higher lows, it means that the market is moving in an uptrend. If we have lower highs and lower lows, this means that the market is moving in a downtrend. And if we have also if the price of a certain instrument is moving is trading in a certain range, in a tight range, we aren't witnessing like a higher highs or higher lows sequence. We are moving in this almost the same. We are trading in the same almost the trading range. This is called sideways trading, where we can have something like a horizontal channel where the market is moving between two bounds. So we'll move with the trend lines. This is a trend. I show you an instrument. This is oil chart. this an instrument can trade sideways, can trade in an uptrend and a downtrend. So it doesn't need to be to stick to a certain price movement. So this is oil going up. It is an uptrend. We can see here series of higher highs. This is a high, another high, higher highs, and series of higher lows forming an uptrend. So this is a small example of an uptrend. This is a downtrend. We can see a sequence of lower lows and lower highs pointing down. So this is a downtrend. And this is the trading range that we are talking about. The market kept trading in the same range for a while, wasn't able to break above certain highs, neither was able to break below certain lows. So there weren't some key market movers at that time. So this kept the buyers and sellers in balance, leading to this price formation, which is consolidation, which is almost a consolidation. And we will talk in this webinar about patterns that are formed in such consolidation levels. So after witnessing a certain move in trend or a certain trend in an instrument, we witness some pause in this trend. This pause will make a formation, and this or pattern. This pattern will decide whether it can give us an assumption whether the market's going to continue to the upside, or which is a continuation pattern, or we will be reversing from this pattern, which will also be a formation of a reversal pattern. We'll talk about continuation and reversal patterns during the webinar. So this is so these are the trends of a market: uptrend, downtrend, and sideways trading. This is a trend line, an uptrend line. So as we said, an uptrend is a series of consecutive higher highs and higher lows, where the overall direction is upward. Usually, investors would buy in such scenarios. There's a saying: the trend is your friend. So when you're always following the trend, you should be in a better place than chasing some shorts in an uptrend or chasing some longs in a downtrend. So this is a key aspect that you have to follow if you want to trade properly. So this is an assumption of an instrument, a price of an instrument. We can see here a certain high, and then we have a low, and then we have a higher high, and we have a higher low, a higher high, and again, and the higher low. So trend lines, they can be drawn between any 2 points, but they aren't confirmed as trend lines until they are retested for the third time. So this was the retest. So here, for example, we had these two highs and these two lows. So here we drew this trend line, this line combining these two lows. So traders will have an assumption that when the price goes down to this line, we will witness another rebound. If prices, if the price was able to break this line, then this could mean that the market is moving, is changing direction, and then traders could sell. How can you trade a trend line? So usually when we're trading in a trend, usually traders would either look for buying the dips, or they would be looking for buying another high. So if the market is breaking above this high, so let's say we have this high and this low, and we are trading somewhere in between, so we have to set some maybe buy stops near the previous high, and then or a trader can buy somewhere in between and put a stop at this low or at the previous low. So we have to use these highs and lows for entry and exit for a trade. So this is an uptrend. I'm going to show it to you also on an uptrend line. I'm going to show it to you also on the chart. This is a downtrend line, a series of consecutive lower lows and lower highs where the overall direction is downward. Usually investors short the market or sell in this market. Also, we can see here a low, a low and a high, and then a lower low, a lower high, lower low, and again a lower high. We combine we combine these highs to draw the downtrend line, and investors will be waiting on this point to see whether the market's going to reverse and or the market's going to continue to the downtrend. So here the trader would have to make his decision. Usually if a trader wants to sell here, usually they place their stops at the previous high, and if they want to go buy at this level, usually they put a stop at the bottom. But here they are risking that the market, they are buying in a downtrend, and there is no yet a confirmation that the market rebounded. So this is what usually traders would do when trading, when reaching such a pattern in the market. So this is a trend line here. we can see a series of higher highs and higher lows. The trend line combined the first couple of lows, and then here the market retested the trend line 1, 2, and 3 times, and then when the market was able to break below this trend line, uptrend line, we saw a huge reversal in the market. The market dropped sharply after breaking this trend line, so this trend line was valid. Also, this is a downtrend line showing lower lows and lower highs, and the market was able to rally higher when this trend line was broken. So these are two examples for trend lines, uptrend line and downtrend line, and how to trade them. The channels, it is a completely the continuation of a trend. So here, if we have a look at this pattern or this formation, so here we are using a line to combine the highs. We also combine the lows to have a channel. So this is here, it is example when the price is moving in a downward channel and in an upward channel. Also, traders will be waiting on the borders of this channel in order to buy and sell. So usually, if a trader draws this channel by combining these two highs and these two lows, you'd be waiting for buying either at this bottom here and selling at this top here at the top of the channel. So a trader would be trading the move inside the channel, and when the price breaks above the channel or below the channel, then the trader also could execute another trade. So this is for channels. This is an example for a channel. Here you can see the price is moving inside this channel all the time. For example, if we're drawing this channel, we took this high and these two highs and these two lows, and the market retested here and retested here. So the trader was able to buy here, sell here, and then buy here for a small profit, buy here for a small profit, and then short here again, and short three. So we got a couple of trades within the same formation. Also similar here. So we were able to draw this channel when we had these three, and then the market rebounded from this price and then rebounded again from this price, dropping to this key point also here, and then having a rally higher. So we got a couple of trades also from a simple formation, which was an upward channel. So I'm going to move to the MetaTrader 4 platform, our trading platform, in order to explain to you how you can draw trend lines and channels. So it's very simple. You just have to look at the chart. This is the chart of the Dow Jones on the hour time frame, 1 hour time frame. So for drawing, so let's say we are having a look at this formation here. It is obvious that the market went down. So when the market is moving down, we have to draw, for example, this trend line combining these highs, for example, the highs here and the highs here, these two key peaks, and then the market bounced off the third time, and then when the market was able to break above the trend line, we rallied to the upside. So this is a small example of what happened when with the Dow Jones when this trend line was broken. Also here, if we can have a closer look on the recent moves, also if we want to draw a trend line. So drawing a trend line is very easy. You just click here on this button, and then it would be ready to draw it. So you just click the first point and the second, and then you can adjust it. So here we have a trend line also. This is the first and second line, and here the first point and second point, we drew this line, and then the market rebounded from this third level and bounced to a higher high. And when the market was able to break below this trend line, we witnessed a rally lower, also supported by fundamentals. So we witnessed this rally lower in Dow Jones. So this is a small example for trend lines on the Dow Jones. This is for the Canadian dollar. Also, we have this downward the downtrend line showing that the market is moving down. We had a series of lower highs and lower lows in the market, a low, another low, and another here, lower high, lower high, lower high, lower high. So the market was moving down. We got some really good trade here if we were drawing this trend line from just combining these two peaks at the top. So this also was a good rally. And here, when the market was able to break above this trend line, we witnessed a rally higher. Also, if we delete this trend line and look for this one, it is a new one. We can see that the market today it traded near this trend line, so it is valid here. We had this trough, another trough, also 1, 2. The market retraced here and then here again, giving almost a 40 pip move. So this is for the USD CAD. We're going to talk about the the British pound for channels. So here we had a move in the British pound last week and the prior 2 weeks. So the market was moving inside a certain channel, low and the high and the low, and then the market retested this trend line. So if you want to take the picture as a trend line and not a channel, so here it is the first 2 points for the trend line, and here we have got another entry for the third point on the trend line, another here, another entry, and the market rebounded when it reached the top of the channel. Also here there is a trend line combining the lows, the recent highs of the British pound 1 and 2. And here we are awaiting for a trade if the market comes in closer. Let's try to draw a channel maybe here. So we use this trend line here. If we extend, it is also easy to draw the equidistant channel. Just click on this button here and then it would be ready for you, and you adjust it on the tops and bottoms. So here also we had almost this the price moving in this certain channel. Here we got a huge rebound from 122.50 yesterday to almost 123.75. So we're talking about 120 pips with a reversal from this channel, downward channel. So it's very easy to draw these trend lines and channels, but also you have to make sure that these trend lines and channels, they have certain value in the market. So you get better at it when you experience it. So technical analysis is all about practice. So you have to keep practicing technical analysis, trials and errors, in order to reach a certain profitable assumption that you can rely on for your trading. So this is for trend lines and channels. We'll keep the questions for the end, and now we'll continue with my colleague Sai talking about supports and resistance. Sai?
Hello, everyone. This is Sai joining. Hope everyone is doing good. So while was going a very good explanations, small information about the trend and trend lines and channels. So just we are going to touch back something. It's a throwback of those who are new listeners, those missed the chance last week of webinar. I'm going to give a small intro about the support as well as the resistance. So like in a technical, basically like support and resistance stands as a certainly it's a predetermined levels for the price of any instrument to give the stop or reverse movements in the markets. So if you say the support, which support force the traders strong enough to overcome the selling pressure. Basically, support stands as the at a lower level where you can buy back. It's mean any decline happen in the markets, for example, number of times, for example, you may see a number of supports levels in the weekly basis, even it works very good on daily basis. So that's how exactly supports basically works, and we have get a chance to buy back. You get an opportunity to buy back again in the markets. So if you're talking about the supports like minor supports, which for example, if a price trending lower, it makes a low, then it bounce back. So if in that sense, I can go to the next. I given a small a chart, a screenshot here. We can see n number of times it has tested the major support levels here. So these all the support which you can easily identify by any time frame where the markets to bounce back. So you can take the opportunity whenever you feel that that level has been testing to take the chance. Basically, the support which is a price trending lower, it make a low, then bounce back, then start dropping again back. So that was exactly the support main. So same way, when you're talking about the resistance point of view. So when I go to the next slide, if I go the resistance, so it's exactly the same way as support is data. Support, it's in the bottom where you're going to get chance to buy back. When in case coming to the resistance, selling force of traders is strong enough to overcome in a buying pressure. So basically that point of level, there are the buying pressure is no more, like you can get overbought. So these are the same way, which is exactly opposite to the support. So you can see some in the screen, in the slides, we can see n number of times, the 1, 2, 3, 4, and fifth time. So whenever you touch the important resistance level, so it's sell off. It give a chance for a downtrend where you can take opportunity again on the selling side. So this just a throwback for the people who are like to get some information of the basic information. So in case of any support resistance provide in any analytical insight and potential trading opportunity. So basically these are the chance you get on the markets. The major supports are the price levels that recently be a trend reversal. So any type of levels which is seen on support resistance, so which is a really a trend based. It can be compared with a weekly basis, or we can say on timely basis like 1 hour 30 minutes. So every time frame has a level, different levels. Even you can do on daily basis. So even daily has a different level of support resistance, where you can say R1 levels, R2 levels, R3 levels, or you can say support 1, support 2, support 3. So whenever you see a support 1, there are chance to buy back. You get a chance, and you can keep a stop loss of support 2 as your stop loss. Same way on the other side, whenever the market touches the resistance level of 1 or 2 or 3, same way you get a chance to sell off. So this way the support and resistance are very useful, and since it's a basic term or a basic pulse of any technical analysis to know about support resistance on a daily basis who are into the market with the technical analysis. So that's why we want to touch base this thing for those who are missed, or maybe to come along with this. So in coming slides, we are going to see more on about like patterns and all stuff. So that's Mr. Wael will be taking over now from here. Thank you.
Thanks, Sai. So just to add for what Sai was saying about support and resistance, also you can for the trend lines and channels that we were using or we were drawing earlier, you can use them as support and resistance. So these are the points that where sellers are looking to join again. So this could be a resistance level, and these are the levels where buyers are looking to enter the market again. So this is a support level. So the borders of the channels could be taken as supports and resistance. So support could be here and resistance could be here. Similar for the trend line. Also here, the trend line here, we expect some support near this trend line, and also here we expect some resistance near this trend line. So also trend lines and supports can be supports and resistance can be drawn on trend lines and channels. So now we'll move forward with the continuation with the patterns. So as I said before, there are some after witnessing a certain trend, like in this picture here. So the market was rallying. We had an uptrend, and then the market entered a certain pattern, and after this pattern the market continued. So this pose is usually the pattern that investors do study. So after a certain trend movement, we witness a certain pose in the trend or a certain pattern formation. This pattern formation, it shows or it allows investors to have some assumption whether the market is strong enough or the rally is strong enough to continue, or the rally is weak and we could witness some reversal. So these are the reversal and continuation patterns. We'll start with the continuation patterns, and then Sai will talk about the reversal. So these are the continuation patterns. They occur, as we said, when prices move sideways after the formation of a trend. So we had an uptrend or a downtrend, and then when the market takes a pause, it will move sideways in a certain formation. This formation could be continuation formation or reversal formation. For continuation patterns, we have some patterns that that investors do recognize, and they are most recognized among traders. So the continuation patterns usually they support in so we have an uptrend, we have this continuation pattern, and then the trend will continue the same as prior. So we will continue on the same trend. That's why it is called continuation patterns. Among these continuation patterns, we have the most known, the triangles. So a market can be trading inside a triangle following a certain price movement, and this triangle will give us a hint that the market could continue to the upside, so we have to trade this triangle. Also, there are some less known patterns. They are similar to triangles. They are flags and pennants. Also, they happen in a shorter period of time. The more time it takes for a certain pattern to be formed, it is the more it is valid. So we have always to look for the time for this for the time of formation and the accuracy of formation and how clean is the formation in order to decide whether it will be successful or not. There is something now instead of doing manually drawing your pattern formations, there are also some indicators now that they can do this for you and give you some certain probabilities on the success, the probability of success of uh, a certain pattern. So let's move forward with continuation patterns with the triangles. So we have, as first we start with the symmetrical triangle. A symmetrical triangle, usually it is a neutral pattern formed by upper descending and lower ascending lines. So we have an up trend line combining higher lows, and we have a down trend lines combining lower highs to reach a certain point where these two lines intersect. This will form the symmetrical triangle. At the time that the symmetrical triangle is formed, usually we have no bias in the market. It is neutral since we have a series of higher lows, but also we have a series of lower highs, and they are symmetricals. So I'm going to show you in the coming slide how they look at. So this is a symmetrical triangle. We had a move down, the market was moving down, and then this pose happened. We have this low, and then we have a higher low and another higher low. Also it is so symmetrical, and here we have a high and then a lower high and then a lower high. So the market is consolidating in a triangle formation, trying to form this triangle. And when the market, if the market moves lower here, then the market is breaking this triangle to form another low. So the market is continuing the previous trend that we were witnessing here. So to recap, to restate again, we had this downtrend, and then the market, there are some buyers here, there was some support here, so buyers jumped in the market and were able to, the certain instrument was able to recover some of its losses, and then here we witnessed some resistance, and then the market moved down, and then again here some support, and then some resistance here. So these lines are joining the support points and resistance points, and when here finally the price was able to break below the support zone, the price rallied lower. So what do traders do? They wait for the break of this line and then the break of this low. They enter at the break of this low with a stop of the previous high, or this high or the previous high. So it depends on their the risk appetite. So they choose the stop between this high and the previous high, and also the target would be the highest, the distance between the highest support, the highest resistance, and the lowest support. So the distance usually taken between these two levels, we always draw it from either the break point or from the previous high. So here to have an almost assumption for where the target could be. Usually when the market moves 75% of the target, usually then this pattern is valid. So this is what usually traders do. They sell here with a stop here or here, and then they wait for their target, which could be equal to one of this move. Similar to the uptrend, the market was moving in an uptrend, then consolidated here. We had some resistance levels and then some support levels, and then the market, after having maybe some fundamental drivers in the market that drove investors' appetite to buying this certain instrument, we witnessed some rally higher. Also, investors will wait for the break of this high here in order to buy, and then they will put their stop levels here at this bottom or at the other bottom here. So this is in simple the symmetrical triangle. We're going to move towards the ascending triangle. It is more a bullish pattern. So the symmetrical is neutral because it has a down trend line and an up trend line, one combining supports and other combining resistance levels. So for ascending triangle, it's a bit different. We have a bullish pattern that is formed by a horizontal upper line showing some equal resistances or equal high levels, and an ascending line with higher lows. So since we already explained that an uptrend line is formed, an uptrend is formed by a series of higher lows. Here we have higher lows, but unfortunately we weren't able to break above the previous high yet. So when the price was able to, when buyers outweigh sellers, then and they were able to push prices higher, this will be the breaking point of the upper resistance line, and then the market would rally higher. So this is the ascending triangle. The market was moving in an uptrend. Here we had some resistance, and the market moves from this resistance to this support, and then we had a higher support, but the resistance remained the same. So let's say for gold prices here, we were trading at 1650. The prices goes towards 1700, and here it was a resistance level at 1700. Then the market dropped towards 1680, and then went towards 1700, and then dropped towards 1690, and then dropped towards 1700, and then drop towards 1695. So we have an equal high level, an equal resistance level, where sellers were able to defend this zone, while buyers were jumping in the market ahead of the prior lower level. So here traders will wait for the break of this resistance level, and they will enter here with a stop either at this low or the previous low. It depends on the risk. And also the target will be the distance between support and resistance, or between the lower line of the triangle and the upper line. And we can draw it either from the breaking point or from the previous low. So this is in brief the ascending triangle. Continuation pattern, also descending triangle. It is completely the opposite of the ascending triangle. It is a bearish pattern. Usually it is formed at the middle of a downtrend. So the market is moving down. We have this formation, a horizontal line with equal lows, equal support levels, and a descending line with lower highs. So when sellers are become more aggressive and they are able to push prices below the support line, then we have a breakout out of this triangle. So the market was moving down. We consolidated inside a certain range, certain support zone. So let's say here it was for gold prices, also 1600. Prices found resistance at 1640, and then here 1600 again, 1625, and then 16 here again, 1600, and then here 1610, and the prices were able to push lower. So we have series of lower lows. So here it is a downtrend line with also here a line combining same equal lows or same support zone. So here sellers were strong, and then here also they were able to defend the support zone, but here they became weak against the buyers. Sorry, here they were strong defending this zone, but here sellers could outweigh the buyers and the market moved down. So the entry would be here below this support zone, with stop loss being at the previous high or at this high, and then also traders would wait for such target. We're gonna go to the MetaTrader 4 platform to have a look on how they appear on the platform. So we'll take this. Maybe we have here some formation. So let's clear these first. So here's maybe this could be this was a triangle. Here we can find it. It was we had almost similar highs, similar lows, also a little bit higher low, and then here we had series of lower highs. If you can see here, 1, 2, and 3 lows, and then the market when was able to break below this point, and then it reversed here, also found some resistance near this line combining these two supports, and then the market continued moving downward. If we take into consideration this calculation between these two levels, it was 125.73, and then here it was 124. So we're talking about 170 pips move, and here the market moved from 124.20 towards 122.50. So we are talking also about one to one. So it is equal target, and the market reached the target. So if traders sold here, or were waiting to the breaking of this support zone, so they sold here with a stop loss here or here, and then the market was able to move lower. So they did benefit from all this sharp move lower. So this is an example for a descending triangle, or almost a continuation triangle. We had a move downtrend, and then this formation, and then another leg lower. For the 5 minutes also, here we had some small moves. Here it's a descending triangle. We had the support zone holding, and then the market was moving down. So here also we had this move almost 124.67 to 124.30. So we're talking about almost 37 pips, and here the market moved almost around 40 pips. So it is also equal 1 to 1. So also traders would wait for the break of this point, and then they put their stop here or at the previous level here, and then they wait for 1 to 1 equal level, and then this formation was valid. This is a flag. So also the market was moving down here. It is a bigger formation. The market was moving down. We had this flag, and then we had this continuation pattern. So it's a different type of continuation pattern. It's a flag. It takes less time to form usually, and its break is faster. So these are two continuation patterns on the British pound 5 minutes chart that occurred on 20 and 21st of April. So now we'll leave you with Sai to talk about reversal patterns. Sai?
Yeah, thank you. And right, it was great explanation for regarding the patterns, where we're going to look into some of the few important reversal patterns here. So where you're going to see that occurs at end of the existing price move, suggests a chance to directional price trend, which can be a positive or negative. So basically the patterns are like, trend changing of any trend, levels. So where you're going to see here, it's combination, like it's a variety of continuation patterns. That's one is head and shoulder, a double top and the triple top. So let's move on to the double top now. So the double top, if you say a double top, coming to the head and shoulder. Let's talk about the head and shoulder. The head and shoulder pattern is a chart formation basically that resembles a baseline of three peaks. So if you see from the slide, you can see there is the three tops are there, right? The one, the two, the higher, the lower one. So these are the major type indications or the point where to be notified in a head and shoulder patterns. So out of these three peaks, outside two are close in height and the middle in the highest, right? That's what you can see very easily. See, this head and shoulder patterns is be believed to be one of the most reliable trend reversal patterns among any other, because which gives you a very good trend based reversal, which really understand and you identify this particular point breakout levels. So if you see from here, the trend was an upside move continuously, yeah, and there was a slight correction. So as we discussed last time with the Fibonacci retracement, we can easy to identify this type of corrections, maybe like it can be 73% or maybe 23% depending on the either side. So this can be identified easily. There is a bounce back. So you got a chance again to buy back. But when coming to the head and shoulder patterns, it take a long way to understand, to wait patiently to understand how the waves are going to be formed in a pattern way. So here it went up, came down and made a big support here. That's why we are discussing about the support resistance to touch base on this. And there is a huge bounce back, and it was slightly higher than the last peak. That's what I was saying. There was a two peak lower and there's a middle peak was a higher levels. So here you can see the bounce back from here. It went to the top and it came corrected back, but not broken the lower of the previous support. So it made, it's like almost like a W wave and it went back again, you know. So these two are the levels which we can say it's a neckline. You know, normally we say as a neckline in a technical term, basically. So you have to start learning about the technical terms, because these are the patterns have been proven. So in such cases, like two are the major support stands here, and there is a height came and it trying to break. So now the formation is completely formed as like a head and shoulder. You know, these two are the shoulders and these are the head. This is the one head. So it forms like a shadow or head and shoulder. When there are strong break happen on the neckline of this support, so there is a big trend change happens in this. So this is how exactly the head and shoulder speaks about. So if you talk about head and shoulder tells what exactly it tells about. It tells majorly the long run of the trends. Even this appear on any time frame, even it can say shorter time frame, but still it's more effective and more give a good performance result on while talking about 30 minutes, or we can go for hourly basis, 4-hour charts daily, or measure walks on daily, weekly and monthly, because the trend changing type of patterns, this all is a very effective one. Similar to that head and shoulder, there is the inverted head and shoulder. It's exactly opposite to the head and shoulder, basically. So again, the same thing happens here when the trend is keep down and coming down from the top, and it made a resistance. You know, the first resistance levels here, and it fall back again to the lower and couldn't able. So these are the levels we can say bounce back, you know, levels where there is a over sold happen. So since there is again went back, but since there is a strong resistance made already in the previous peak, if you know, previous tie, so it came back again. So you can see the inverted head and shoulder here, like two shoulders and a 180 form here formation, and again the market's trying to break. See, very clear about this very important point to notify that these are the levels are very difficult to break out. So breakout, basically breakout levels, because it's not easy where the markets just like it break. It comes to break out with a huge pressure of volumes, and you can say huge trend based reversal happens always in this mark in this levels. So here it's like a formation happens, come again the top, again second resistance, and it given a small low which is not to the almost a top low. I mean, it break again the resistance. So then the market trend is started. So this formations is a very good, these patterns are very good in the markets. It's really reliable on the markets, where you need to identify. So before executing this type of patterns, identify these patterns, you should make sure that you are practicing n number of times and making some a previous history data to analyze it properly to know about it. Even this is can be seen not even a line charts, even it can be seen in a candlesticks type of charts is easily mentioned here. Like there are type of head and shoulder, it's very difficult to identify, but still if you identify these levels of break or neckline, then you made the day, right? You are going to take a call on the directions of the trend. So always a trend is a best friend, right? So obviously this helps you in this way. Like this is a shoulder formation happened first, and it came here, and there was a downfall here, so there is a bounce back, but still it's formed. Even there is not a slight horizontal line, but still it forms as a neckline here, because these are formed with combination of a trend line channels as well as keeping a support resistance on a flat way. So these are the levels. So when that has been broken, you can see a move in the markets. So just I'm taking examples. There are n number of examples in the markets, but we have to go through practice one by one. So here we can see a small break happen in the trend line, or we can draw from here also. Even you can take this line, if it comes here, it may come around here. For example, you want to keep a perfect horizontal line, so it comes here. Even it's broken this level, you can see a trend happen moving on the upside directions. So this is one of the best and reliable patterns. Definitely you can have a practice on a regular basis to identify it. Even we're going to see, if possible, on the times permits, we're going to see a small one or two examples on the MetaTrader platforms. So this is all about head and shoulder. Let's move on to the next patterns, which is double top and double bottom. So this patterns also like a type of reversal back patterns. So you can see this is also an easy way to identify. From the name itself, we can understood that. It's like a top M or W-shaped reversal patterns. So these are markets are uptrend or downtrend and have two peaks. There we have seen three peaks, but two are in the same level and one is in the higher level. And here there's a two are in the same level. Either side you can say it's like a two top, like M, capital M, or you can see capital W. It's these patterns frequently you can see in any type of time frames. You can take 30 minutes. So basically, everyone trades a short-term time frames. They spend some 2 hours, 3 hours in the markets. They normally choose 15 minutes or 30 minutes. It's available. This type of patterns is easily available in the trending markets. So we can see like if there is uptrend happens here and form a resistance, a strong resistance happened, and you can there are small support and again bounce up, but it couldn't be able to break the last previous support resistance level. So there again the market is keep falling up. So where you get executed, where you go to enter the markets, not here or maybe not here or not sure, because you'll be waiting for it. You suppose this breaks and is going to be a bullish. So obviously like this not happened in case of double top or double bottom markets. So here double top markets, like it came down and it was trying to break. As I said, these are the important levels or been to break out. So it's very important. So basically when this started coming down, then your execution starts here. You're going to go for a sell, and there are two different levels of stop loss we can keep depending on your risk factors or depending on your money management or risk management of any individuals. So you're going to keep a stop loss year and a half of the way, or you can keep a top loss as a maximum risk, But if you keep a maximum risk of year, then definitely there is no any type of consolidation. It may chance to miss your stop. Sometimes a low risk based traders, you can take a mid of the stop loss. Maybe that level may be a day resistance, or maybe some important resistance can able to identify by giving all this type of levels. So here the entry starts here. So the targets keeps running and the markets keep pushing on. So you are being on the traveling on the seller side. So you'll be on a sell side markets. The same way, if you see on double bottom here, the same, like it's exactly opposite of what we're discussing about the double top. So there was a downtrend happen and they made a low here, that there is a strong a buying pressure happens, and it came back to the any news or any type of technical levels. So it made an important resistance at this point and bounce back again. So when just crossing this breakout level, definitely there could be a rally again. Same, it's the fundamental the same parameters applicable here, or we can say same type of yeah, a protocol you're going to follow here, because you're going to enter into the market. Either your risk trader can keep a stop loss below this level, and you can enter, or we can keep a 50% stop loss, maybe by keeping a Fibonacci retracement level. Like, this all helps you. Whatever we discussed in the last webinar, this is going to help you on a coming session also. Like, it's going to it's all interconnected. See, keeping only one patterns, sometimes it's not give you the good performance on your output. So keeping all multiple type of patterns, type of other tools, which helps you to get it. So this all be help you by keeping a stop loss, by some other type of levels. We can keep some resistance or support levels. So here what happens, breakout happens here, the keep market is moving up. So this is all about the double top, double top and double bottom. So let's move on to the a triple top, a bottom. What we discussed, there was two eyes, two tops made here. The three tops have been made here. So example, the same way, but this is take time. It's maybe you are maybe waiting for a double top, but unfortunately, due to some reason, market has bounced back. But still, it's very good levels are there. Two levels have been there. Maybe first level you made seen the supports, first support. But the second time, you have a very good chance. We may chance market may reverse, or maybe you can bounce back. Either risk trader can take a chance of this also by taking a buy call here and keeping a stop loss on the below here. But here what happens came. So, but it made three resistance level top, where it's very importantly maintained. Sometimes this may be higher, slightly lower, or this may be slightly lower than that. But it cannot be every time in the very high level, all the levels to be similar, or all the point price will be similar. Sometimes some difference, but it understood that in the long way, like, it's a triple top bottoms. Even this patterns regularly appears and regularly comes on any time frame. Don't go to a lower side of time frame, because it's like a fluctuations, it's like a 5 minutes, 10 minutes, 15 minutes sometimes also. But if you want to clearly understand this patterns, to take a chance opportunity of this type of patterns, go for a long term, quite long term, like 30 minutes or 1 hour or more than that. That helps you. So there is a breakout happens here. He cleanly breaking out the third time, he's trying to break. So once that's broken, again the same process, the strategy applicable. Risk trader can take a risk here, or maybe you can keep a stop loss here based on any other informations, and be on the market on the downside. So it's double, triple. Got my point? What I'm saying. So it's very easy to understand. Only thing, triple is take some more time to get the patterns to be formed in the chart. But double, as usual, you can see every regular time, every regular time, and get a chance to buy. So when you're coming to the inverter triple top, it does mean you can see the opposite side, the bottom of the triple top. It's same. Like when there is a downtrend happen in the markets continuously, and there is a bounce back, and they form the two type of resistance, which is again market bounce back. So it is the breakout points where the target is going to be continued. So how the target will be or the target will be placed based on this. Maybe where the market has been fall, where it started to fall, till that point you can fix up targets, and you can always trail your stop loss. As I mentioned here, this is a maximum risk. Move on the risk here, and you see a small resistance here. Keep it below about the trailing stop loss, keep moving out. So that makes sense to you're traveling the trend. Just buy here and book it here, then you'll come out from the market. Maybe this trend may be a continuously be a long term. It maybe move on. If you take a chart for daily, it may move for 10 days, 15 days, or 20 days, more than that. So these are exactly the triple top, the double top helps you. This is an example which I shown you, a small example on a candlesticks. Even that's very good example shown here. There are a lot of examples you can see in the charts. You can identify very easily, but only thing you have to understand, practice this n number of times, unless you get your proper confidence on the particular chart, keeping mix up and combined with other tools as well. Right? Hope you enjoyed. Thank you.
Okay, so we'll answer your questions now. We have a couple of questions here. Okay, so first, how do you assume the drop of a trend line after ascending if you want to consider basic technical analysis? How do you assume the drop of a trend line after ascending if you want to consider basic technical analysis? Sorry, can you have another question? It's not I couldn't understand your question properly. How do you assume the drop of a trend line after ascending if you want to consider basic technical analysis? Can you reform your question, please? And do we have any questions? Other questions? Yeah, hopefully we're gonna take your email and maybe send you we'll send you also the slides. Sure. Perfect. Welcome. Do you have any strategy that you can share? So for strategies, hopefully we're gonna be talking about strategies in the coming webinars. We'll always having like one or two educational webinars throughout the week going forward. So it's just for slightly beginners, and then we'll raise the knowledge curve slightly. So for strategies, this if we want to use these are very simple if you want to use the classical technical analysis. So we explained how to take some trades using this classical technical analysis. So some people, they only use price action. They only add some indicators for further filtration for the break, and then they trade their only strategy would be price action, trading trend lines, trading channels. So I believe that this could be one of the strategies. For further strategies, more developed, advanced, we'll be doing other webinars, or also you can contact us at support@ICM and ask for a one-on-one session. We'll be also explaining some strategies. Sai, if you want to answer some questions.
Yeah, please.
Okay,
And let me know.
so the question now is, does it work? Does it also work the same for commodities? So as we talked at the beginning of the webinar, that technical analysis can be applied on commodities, currencies, stocks, on everything. So you can apply your technical analysis on different instruments. So that's one of the advantages of technical analysis. So yeah, you can apply it on commodities. You choose your certain financial instrument and you apply these technical analysis studies on it. So you can do classical technical on any instrument. Uh, what about how to use Elliott wave to trade? The Elliott wave is also is one of the big schools or good schools for technical analysis. But also you can merge price action with Elliott wave. So usually these classical technicals that we talked about, they usually happen on the fourth wave and Elliott. So you have to combine between Elliott and classical technical. You get some good analysis. Any further questions? Okay, so Sai, a triple top bottom usually take how many time? Can you answer?
Sorry.
There's a question about triple top and bottom usually take how many times? So somebody is asking. I'm just reading the question. So
No, basically the triple top itself mentioned that it's a triple times. Maybe it can one more can continue because it's not been derived or something like that. But we kept as anytime it may be bounced back n number of times. Normally we say that it's important resistance and supports. But we keep it on the line, so keep it as on a proven the patterns, which is a double and triple. That's what we did. But it can happen once or twice. But if at all it's not breaking the break-even level or breakout levels, or maybe it's not crossing out, a strong breakout happens with the resistance and supports. Even we've seen a couple of slides which is maintaining the support resistance on a one way, but it shows that is n number of times it has been chance to given a bounce back, right? Happens in that, but it's not a most of the cases. But reliable, always keep it a double, and triple top is always reliable because it's been worldwide followed and it has been proven many times.
he's questioning the range time, Sai. So how much time it would take to form this formation?
No, usually when he's talking about the time frames, it's like in case of 30 minutes, if you sell it like you're an intraday trader or a day trader, basically, if it forms on 30 minutes or 1 hour time frame, normally it takes at least, if you see the slides, the markets fall up, down, it may take at least, it takes is 8 to 9 candlesticks or maybe line time for 1 hour charts. So it's very important to be a patient, to wait for the formations, So the formation will be confirmed only the time of neckline or maybe the head and shoulder or double top, triple top in the breakout levels. Unless and we can't able to analyze ourselves, assumption ourselves that this is going to be a double or triple, right? So form the line, keep ready with your charts and lining, trend lines, everything. Make sure that there is other important levels. And one that's been occurred, it may be, maybe it follow even, see, sometimes within this time with the resistance and support of both peak and the lower, it may take different levels because the market has to move, and mostly these are consolidations, right? When the after consolidation only the market is going to break out or the double top or double bottom. So in the 30 minutes maybe take at least a formation of 8 hours to 10 hours, or talking about the lower time maybe 3 hours. In case of 1 hour, it may be more than 8 to 10 hours basically.
Okay, so there's someone asking about in-depth information regarding analysis. So if you have an account with ICM, you can contact us and we can give you one-on-one sessions tackling more advanced technical analysis, more advanced analysis, not only technical, fundamental, market sentiment. It depends on your level or the needed level. So so feel free to contact us. Any further questions? Sarah, are you uploads? Yeah, sure. We'll have this video on our social media platforms, also on YouTube, Facebook, also Instagram. So we'll have it. You can watch it again. It's favorable to trade while using the higher highs and higher power. Yeah, it's always better to trade in a trend, of course, than trade. It depends on your trading behavior. So if you prefer trading breakouts, it's good to have to wait for a certain consolidation range to trade, and then to trade the breakout. And sometimes there are other type of traders where they wait for the extremes, so they would be so happy with the trade in a range because they would sell the high and buy the low, so they would be getting their moves at the troughs and peaks, so they would have good entries. So it depends on their trading behavior. Yeah, there is a question that if you have to do if you have to apply your technical analysis, whether you have to always start from a weekly time frame and then go to lower time frames. Yeah, it's better to always go from a bigger time frame to smaller time frame in order to have like a bigger picture and then zoom into the latest moves. So it is always better to go for from the topper time frames to lower time frames. It is always recommended.
Yeah, Mr. Wael. Because it makes a lot of noise when you're going to the minimum time frame, like 5 minutes, 10 minutes, or 30 minutes. But you are in a learning stage or trying to understand how exactly the patterns and trends works. Better always go for a higher level of time frames to understand better.
Yep. Any further questions? Okay, so there is much appreciated, champion. Thank you. Thank you so much. Support and resist better to draw using line or zone. Sai.
Yeah. Say again, please. Sorry.
There's a question. Support and resistance better draw using line or zone.
No, it's basically it's a horizon. Keep it on the horizon line. Always keep it on that way, because that's levels always as a breakout event happens. So the pattern which shows as well as the support resistance also based on the horizon line. So keep it always in that way, because horizon line keeps you the break event level of any of the instruments which says as per the patterns. So definitely we can keep it on that horizontal type of plotting the charts.
Okay, so there's another question. Which one is more easy to use while analyzing patterns, candlestick or line? So it depends. Sometimes some traders do draw use the high, the candlestick chart. It will show the highs and the lows, while the line chart will only show the closing. But also some traders, they use the closing as a filter, so they need the certain close above a certain triangle or a support zone or resistance zone in inverted head and shoulder or a head and shoulder pattern. So they would use the line chart, but it doesn't always matter because the difference is a little bit is negligible. So it doesn't show. You can draw it on both, and then you have a combination between the support zone or the resistance zone that would be broken in order to move with the trade.
Basically, the person who familiar with which chart it is, right? So if they're
Yeah.
familiar with candlesticks. They can always analyze with the same type of charts. If they are very familiar with the bar or line, always go with that. So that make you sense to go along with the what you learned or what you practiced.
Exactly. Any further questions? When is the next webinar taking place? Okay, so first on Monday we are holding market update webinars. So it's just a walkthrough on the top movers, what to look for in the coming week, and also apply some technical analysis using using indicators and classical technical. And on Wednesday we are holding educational webinars. So it depends on if you wanna have both. So on Monday, it's a walkthrough for the coming week and discussing the movers and doing some analysis. And on Wednesday, it's educational webinar. Okay, we'll remain for 2 more minutes if there are any further questions. Yeah, we are always posting our webinars on social media, so you can find it either on our YouTube channel, on our Facebook, Instagram, so you can find it, or you can contact support and ask for it, and they will send it to you. Any further questions? Last question. Okay, so I believe that's it. So thank you for joining, and hopefully we'll get in touch on other webinars. Sai, do you have anything to say?
Thank you so much for everyone. I hope we'll meet again in our next webinar soon. Thank you. Thank you all.
One other thing before you go, I've been trying to log in MetaTrader for using my ICM demo account. I've been struggling. How do I go about it? Okay, I'll send your details to the support, and they will contact you in order to fix your issue. Most welcome. Thank you all for attending, and thank you.